Aaron, you're so absolutely right. And you know what comes to mind with capital calls is that they're not to be feared. And it's not the end of the universe for an investment if that happens. However, it is important to understand why. And when you think about real estate and you think about long-term versus short-term investments, like real estate is not crypto. It's way more stable and way more valuable. And the beautiful part of it is it's more like slow cooking meat. You know, down here in Texas, we do that a lot. It's one of the barbecue places of the planet. And when you're cooking barbecue, like you have this fantastic piece of meat that you start with. Like think of that as the property. And then you add all these amazing spices and you choose the perfect temperature and the perfect smoke. But when you're about a third or half or three quarters way through, you're probably going to baste that. You're probably going to add some more spice. And all that does is give you an even better, phenomenal meal when you share that with friends and family. And that's how I see this real estate business. It's a slow cook. It's no microwave here, but you ever so often you need to rebaste and respice. In the end, you have a fantastic return.
You're listening to the Real Estate Runway podcast powered by Quattro Capital, where we're all about alternative business and investment strategies to help you amplify life and maximize wealth. Here's your host, Chad, the investment maverick.
All right. Real Estate Runway family, welcome to another special edition episode of the Real Estate Runway podcast. As you can see, if you're on video, I've got 4 out of 5 members of the Quattro team with me. Mo couldn't be here today. Sadly, is traveling to come speak to some of you lovely people, so we will miss him dearly. But look, before we get into the super exciting topic we're going to talk about today, which is the elephant in the room, capital calls. Okay. Let that echo for a minute. We are going to actually say, look, if you get any value out of this or anything we do here at Quattro or Real Estate Runway, look, just interact with it. Hit the share button, send it to someone you know who needs to hear it, pay it forward, like, swipe, subscribe, whatever you're on, just do something. And that tells the algorithm you'd love it and it'll show it to more people. Now, without further ado, welcome to the show, Kim, Tammy, Aaron, you amazing people. How are you today?
Awesome. How are you?
Good to see everybody. So as mentioned, we don't often get on the call together here to talk to the overall audience. Well, it truly is a global audience. We have people in India listening to us, which is pretty cool. So I want to talk about something that has really been I think some people have considered it a cuss word or a bad word in the private equity space. And honestly, it is actually a very common thing in most types of investments. That is the capital call. You're seeing more and more of them happen today. So we're going to talk about what they are, why they matter, and what might be some of the common stigmas behind them, as well as some of our experience in the area. So what I'd love to do is initially, maybe I'll pass it over to Kim if you don't mind starting us off. Will you help educate us on what a capital call is, how common it is, and maybe some of the initial stigma around it to start us off?
Yeah, this is a tough one because I know it is a common thing, but it's also something we've worked hard to avoid doing. So a capital call simply means, wow, you invest a certain amount of money. Let's use a round number, $100,000. And with that $100,000 investment, you expect returns. And so do the people who are offering that project. But things happen. The uncontrollable things in the world happen. And as everybody knows, the last 2 years we've been living through a lot of that unexpected, quote unquote, black swan event. Excuse me. What a capital call simply means is the investment is weak in cash and or time. And cash solves most time problems, and cash obviously solves cash problems. So in the world of investing, we call cash capital. And when the investment requires more cash, there is this thing called a capital call. And what's interesting is that so many people are relatively new to real estate investing, and it's been phenomenal to watch this evolution occur. And before I jump too far, Chad, because I think I'm headed too far, let's just stop. Does that make sense what a capital call is?
Well, I think it does. And you know, even going a step further, there are a lot of investments out there where a capital call is part of normal business, right? It is assumed in a lot of real estate offerings that, okay, you invest money in the beginning and that money will cover capital expenditures, construction, whatever it is you're doing. And then after a period of time, it will start sending you distributions and ultimately a sale. You know, there are
Right.
several investment types. I'm thinking of like Blackstone level investments where, you know, many of my investors are our investors are accustomed to, hey, we're going to make a commitment of $1 million or $100,000 or whatever. And over time, as certain, let's just say, business acquisition opportunities, like if you're buying a big business, a lot of times they will get commitments ahead of time and then they'll capital call the money when it's time to actually contribute, right? In our real estate space, it's much more common to contribute right after you commit, you know, and so the time difference between there is very interesting. So just to kind of go to some of the stigmas around it, you know, Aaron, I'd love to go to you next if you don't mind. You talk to a lot of people out there who are invested with us or not, and I know you probably have a pretty good pulse on, you know, in our circles, that is real estate investing. You know, what is the perception on the capital call, for better or for worse?
Right. It's such a good question. I think the more savvy investors, they're more okay with it. They understand. But especially for somebody that's a little bit new, it's perceived as, oh my gosh, a capital call means you're a bad operator. And I can understand where they would feel that or think that, but we also have to understand what's going on in the economy and what's unfolded over the last 2 years, right? And so a lot of people are like, oh my gosh, well, if there's a capital call, were they over leveraged? Did they take on too big of a loan and now all of a sudden they can't service this? Right. And so I think there's different reasons, which we're going to dig into here shortly, as to why a capital call would even be needed. And so if you're listening in right now, we're going to get to the important part. For us, we want to be able to share with you why in the world did Quattro Capital do a capital call? And when you listen in, I think you're going to be highly educated and it's going to be more clear as to why we got to this point after everything that we tried to avoid a capital call. So
That's great, Aaron. And Tammy, I kind of want to hear your take on the question too, because you talk to a lot of our investors who have come in through a debt fund recreated prior to doing a capital call. And so we're going to get to that and why exactly we did that. But, you know, same question to you. What are some of the stigmas or the negative PR just around the word capital call that have come from your interactions?
Well, most of the interactions I've had with the investors is they straight up want to know, am I giving my good money to a bad investment? And real quick, with the property performance updates and everything we do, you know, very quickly, I was able to say, no, this property is actually performing very well. This was actually a lender issue. You know, this was a product of something else, not how we're operating. Your investment is in good hands. We solved this small problem. We are back on track. Da da da. It was never an issue with the property or their initial investment to begin with. So that was the biggest
that you phrased
question. Yeah.
I love that you phrased it like that. Sorry for talking over you there. I love that you phrased it just like that, because that really just kind of teed up the softball I want to send over to Kim is, you know, true or false, and please elaborate, true or false, doing a capital call means the project is in trouble or failing.
Yeah, false for sure. It can mean that. Like there have been plenty of things in the news where a project was set up in such a way that they were carrying too much risk. And yeah, in those cases, the properties are in trouble. But that's not the only reason that a capital call can occur. And I think the easiest way to do to explain the distinction is talk about context. When we shared with our investors in January of 24, when we shared with our investors the situation, the facts and the data show that the property was performing phenomenally. We had increased the average rent by 24%, which means we had increased income by 24%. Our expense loads were improving. The challenges associated with, the market and variable interest rates and bridge loans and all the stuff that people were hearing about, that was not our struggle. That was not the struggle of the property. In fact, the property continues to crush it. And two quick little stats to help people know. Lease trade out is the big indicator of whether or not your investment is advancing or retreating or staying the same. Meaning, apartment gets renovated, how much more rent are we able to collect for that new product? It's called a lease trade out. Our lease trade outs on renovated units were 48%, literally $370 to $375. Like, that is phenomenal. Like, you're happy in this space if you can get $100. This property is hitting 3x that. And oh, by the way, just on a renovated classic unit, we were seeing $100. So, what it used to be a renovated unit, we were collecting that for just a turn. So to say the property was performing excellent, like, I celebrated and bonused our property manager because they were doing that good. So what were the challenges we couldn't overcome? And the challenge we couldn't overcome was a lender that would not fund capital expenses. So what do I mean by that? First of all, what do you mean? A lender cannot do what's on a loan agreement? So let's start there.
Spoiler alert.
Holy smokes, Chad, we should do an entire podcast just on what lenders can get by with. So in the commercial space,
I'm sorry, I have to plug my little joke here. I keep waiting for the commercial. If your lender did not give your CapEx, please dial 1-800 da 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 da. Because so many of those investors have asked me, how is this legal? How are they able to do this? This is wrong. And I've not had an answer for them. I'm just like, yep, they did. So, been kind of interesting.
Well, and that's amazing. That's amazing that you said that, because it's been a very common occurrence. And that it's Kim, I want to interject a couple things here before, because I love where you're going and I want to get there. But just to make a simile for what we just talked about, true or false, a capital call means a project is failing. We've just established that's false. Now, it could mean it's true, but you have to know the circumstance behind it. I'm gonna say the same thing on the opposite side. True or false, and I'm going to answer this one because I know where I'm going with it. True or false, a cash flowing property means a property is succeeding. And that is also false. And here's why I'm going to tell you that. And Kim is going to explain, this situation she was starting to put together for us. But as you're thinking about this, I want you to think about the opposite scenario of what she's going to describe. Think about a property that is actually losing money every month. It has $1 million in the bank account and it's losing $100,000 a month. And the operator is trying to keep his investors happy. And so he's distributing $50,000 a quarter, even though he's losing money. Well, that can appear that it's doing very, very well because money is coming to you. Although if you don't look behind the scenes and look at the quarterly statements and the balance sheet, and you don't realize that assets are dwindling, that's going to come to a head in a very rough and rowdy way at a certain time. So let me pivot that back to where you were going, Kim, because you were starting to lay out, okay, what's the storm that started brewing despite this asset that we are celebrating, how well it's performing? Mute. Kim, mute.
I wasn't in the window. 3, 2, 1. So, Chad, you're so absolutely correct. And I love that you're making this distinction that just because someone is receiving distributions doesn't mean they have a healthy investment. Another podcast we should do. So
Yes.
regarding this topic, though, the lender not reimbursing capital expenses. The lender not reimbursing capital expenses. I want to first say every single draw request we made, which says, here's the invoices, here's proof of the work we did, please have your inspector come, they check it, everything's good. Everybody agrees it was legitimate work, in scope, done at the right price, at the right time. They approve the request, which is a separate process than funding the request. So we have truly approved capital requests that were not being funded by the lender. How can they do that? A, you're right. It is a breach of contract. If you're thinking, go to your loan agreement and sue them, you're exactly right. And that was our initial response as well. I think, Chad, I want to say we talked to 4 different legal firms, all of which we work with and know directly, could have very real conversations with. And 100% of them said, sure, we're happy to do this for you, but here's what's going to happen. That they have way more capital than you do. They're already siphoning you dry. And oh, by the way, this is a multi-year no-win legal case on your part because they can simply outlast you. So when you're up against Goliath, we didn't have a stone that was going to take them down. When you're in that situation and you really only have one choice, and that is to replace the funds the lender was supposed to provide. Now, by replacing the funds the lender was supposed to provide, you're not changing the structure, quote unquote, of the deal. You're not changing the outcome of the returns. You're not affecting the investment as a whole. You're simply replacing funds that the lender is not going to provide. And that is why what we did is so much not Tammy's investor's question, good money following bad investment. It's simply a change.
That's a great distinction. And just to summarize, so we talked about the fact that a property could be losing money, yet making distributions. And we all know that's going to end when the bank account hits zero, right? Well, in a similar fashion, you put a deal together, you buy a great property in a great location, you run it awesome, and you're increasing revenue. Why are you having trouble? Well, here's the thing. Construction's expensive, right? It costs money. And so let's just say you have, we're going to use round numbers, $5 million that you're planning to do construction to improve a $25 million building. Okay. So that's, for you math nerds, it's about 20%. Okay. So that's about, and then you say, okay, I'm going to go get a loan on this property. And I'm going to get, and in some cases, the lender will say, okay, look, I'll give you a loan for the property and I'll also give you construction money for doing the work. And like Kim said, you got to go do the work first, pay for it, prove you did it, show us you got the right rent amount, and then, hey, we'll give it back to you and you can use it again. And so that's how you set up a deal with this kind of loan. You say, okay, well, we have a $5 million construction budget. Let's say we're going to put $1 million in the bank and that's going to be what we spend and reuse, right? Well, paint the situation where you have a great property, you're doing the work, you spent $1 million and the lender doesn't give it back to you. Well, now you theoretically had $5 million. Now you've only got one and you spent it. So you're out of money. All right. And so you only get in trouble in real estate when you run out of time or money. Money is a big one. Well, you just ran out of money to no fault of your own doing the right thing. Right? Despite the fact that a property is performing so well. And so, Tammy, I'd love to bring this one over to you for a second. We find ourselves with a great property performing well, massive renewals, massive rent increases, and we just ran out of money. Right? So we have 2 options. We can either issue a capital call to replace that money, because you either get money from debt or equity. It's that simple. Debt is the lender, equity is the investor, right? Or yourself, the collective investor unit. And so we could have said, well, gee, let's just go ahead and pull more equity in. But equity is the most expensive bucket of money. What did we decide to do and what did we build, and kind of how does it work, so that we could try to backfill that money with something that we wrote the rules on.
Well, the one thing that Quattro always does is try to figure out how to make a bad situation where everybody can win. And that's exactly what we did. We went to the drawing boards. We looked at funds and put one together so to where our investors could come into the fund, and their money is now making more money to help this property continue to make money. So they're actually winning twice. And it was a way to avoid going out and like you said, getting that more expensive money to replace it at the moment. What we were able to do is have our investors have a consistent return if they chose simple or compound, let it build, and they're making more money while we're replacing the lender funds that didn't come in. It was a win-win, and it works great.
And so the idea is there's a middle ground. So we've established we're not getting the money from the lender, right? And Aaron, I'm coming to you next, so be ready. We're not getting the money from the lender. We've spent it. We need to replace it so we can keep doing this great work on this great asset. So we build this debt fund that Tammy's talking about. We bring money in, and because we already had investors saying, hey, where's my next cash flowing opportunity? Well, hey, great. Why don't you come be the lender? Why don't you come do what the lenders failed to do? And oh, by the way, I'm pointing at you operators out there. So this was a magical thing, because now not only did we get that part of the debt out of the debt market where we couldn't control the rules and they weren't playing by the rules anyway, we built a fund where we wrote the rules, right? And also got to let investors win at the same time. So we basically created our own construction fund. Okay, let that sink in. Now, Aaron, let's talk about this fund for a second. So we created it, and then we had to go kind of explain and show the investors in these deals why this was a better avenue than us doing a capital call. So would you mind sharing some of your talk track on that and how this was explained? I think you've really, dialed this down to a science.
Yeah, listen, I think if we go back real quick, the whole capital call is not like, you can hear it left and right. And when we're talking to our investors, they also are invested in other people's deals. And guess what? They're getting hit with capital calls. But I will tell you, there's a big differentiator. And the big differentiator is, I'm not saying Quattro is the best, but I'm saying the position that we were in was that, yes, we needed these funds that our bank already agreed to, but we couldn't get access to them. It wasn't that our property was in trouble. Kim already shared, my goodness, mic drop, $300 in rent bumps that we were getting. So clearly we were performing good. So it really took us educating our investors as to the issue that we were having, right? And so really, when you look at it, Quattro Capital was being super forward thinking about our options that would be like in the best interest of our investors. Because listen, do we want to do a capital call? Heck no. Is there a way for us to find the solution to not possibly be able to do the capital call? And that's where it came in, where Tammy talked about creating this debt fund that we created so that we could just get out that portion from the bank that they were supposed to give us for our CapEx budget and bring in money from the fixed income fund. Well, one would say, I'm still not getting it. Tammy mentioned taking your good money and throwing it at bad money, right? And so we had to overcome this hurdle because those that weren't as savvy in the space, we really had to walk them through and educate them at the same time. So what we did is our team said, listen, as Tammy even mentioned already, we created a way for them not to just keep their money in this particular multifamily property, but to give them two earning platforms. Yes, their money is in the apartment building and it's going to make money. But what if we could take their money, instead of putting it in a capital call, what if we could put it in our fund and they can earn a guaranteed, call it 10% return in the fixed income fund? Well, I'll slow it down a little bit. Think about it. If we've got this fund over here, right? Now we can take the money that's in the fund and we can replace it with what the bank was supposed to give us for the property, right? So now you may be thinking, well, I still don't get it. If you're taking the money out of the fund, how are you paying them their 10% that they're supposed to be earning from this fixed income fund? Aaron, help me out. Where's this coming from? Well, remember what Kim told you? That property in particular that we're alluding to was doing great. They were getting great rent bumps. So we were able to pro rata take the earnings that we were getting off the property to service the debt from the fixed income fund to pay them that guaranteed, call it, return. So it really took their money in and put it in a position where if they really wanted to, they can now get these quarterly payouts and still have their investment protected over here, right? So that's what we did. And it was really a phenomenal move for us to be able to get those funds over to our property the way that we needed to. Yes, we had a small shortfall, and so we ended up doing a capital call. But I think as we get going even more in this conversation, you're going to see that Team Quattro was all about and is about for our investors to win. And so we explored from A to B to C all the way down so we could avoid the capital call and have another avenue, which was our fixed income fund. And it was super successful, but we're still coming back around. So Chad, you can take over from here.
And so that's the tool, right? So we've established at this point, okay, we did a deal. The deal was good. The lender didn't perform. We had to replace the money the lender didn't give us. We built the machine to do that. And we showed everyone, hey, it's actually better to play here than it is to do a capital call because A, you're not diluting your initial investment. You're not putting more money in for the same return, right? And you're also earning a little bit by doing the job the lender didn't get to do in a lower risk position. So that's great. So Kim, back to you. Let's talk about the outcomes of, okay, so we've been able to use that money. Let's say 2/3 of it was filled of the need. And so why did we wind up doing a capital call for the remainder and kind of, where are we going from here?
This is the amazing thing, right? You give people an opportunity to be the bank, to earn the compounding interest beyond just the interest that would be paid to the bank. And most people understood that. Once they understood it, they were like, "Oh, I want to win twice." But there is a segment of investors who were like, "Yeah, I see that. That's really good, but I still need more tax benefits from the real estate itself." And for those investors, they really did need us to do the formal capital call so that the funds that they put in would go into the property and they would be able to receive additional tax benefits. I mean, depreciation is a real thing. And if tax benefits are the primary reason someone is investing, that's why they're investing and that's what they needed to do to come in. What was beautiful, I thought, is that the majority of people had two options, right? They just had two options. The one group that no matter what, we couldn't serve, and that was those who were just tapped out. Like Aaron mentioned, we're all living historically crazy times. Interest rates at all-time highs, inflation sticky and staying very high. There was a lot of people who invested with a lot of different operators and a lot of different projects, and their personal funds didn't stretch far enough. And that was the only group that we couldn't find a way to help because here was the negative impact for them. And this is the part of capital calling that made us so sad.
Mm-hmm.
If you invested in the fixed income fund or you could bring funds in, you could preserve your share of the deal. And the dollar you put in would equal the return you get out. By that, I mean, a dollar means a dollar means a dollar. But if you didn't have any way to play, either through the fixed income fund or directly into the property, then that share gets reduced. So my dollar going in might be worth 95 cents instead of 100 or a full dollar. So 100%. So for the, I would say 98% of the investors, we were able to solve the problem and make sure that everybody wins. The only way everybody loses, or if anybody truly loses, if we didn't solve the cash problem and created as a result a bad investment. So if you think about cash for investments, it's like the gas of a vehicle. Like you can go fast around the track, or you can, fly to the moon, launch off the planet and fly to the moon if you have enough fuel and enough power. And the equivalent of that in any investment, and real estate included, is cash. So finding ways to solve cash problems that make people win in more than one way, that was our goal. And that's the Quattro way, making sure everybody wins. This was the first time that we've not been able to make sure 100% of the people couldn't win. But the investment is still going to yield a fantastic return for them. And that is where we're going to make that up for them in the win.
Awesome. Hey, I wanted to stack on there with what you shared. I loved all of that, Kim. In addition, it was so awesome to see when we had the fixed income fund and we educated our investors. It was so awesome to see so many of them step up and over contribute the amount that they ended up bringing to the fixed income fund. It was twofold. Yes, they get to diversify and make and earn money over here in a different, having two now where they can earn from. But even in addition to that, we got to share with our investors, look, let's be honest here. Some of our investors in this particular asset are not in a position, maybe because they've had multiple capital calls or they have some financial difficulty they're facing. And so we would ask them, listen, I know if you're in a position and you can give a little bit more into the fixed income fund, it would help out some of your brothers and sisters that are in this asset with us and to lighten the blow a little bit with call it a capital call, right? And so it was incredible to see so many of our investors rise up, give a little bit more, round it out, just to help those that were not financially fit to be able to contribute. So it's been such a beautiful thing to watch our investors come together and really try and make this work. So I feel like it's been such an incredible success. Even though we're having to do it, it's a much smaller portion than one could have anticipated. So I feel like it was still a win.
And Erin, you're absolutely right. And what's amazing is for people who invest, you're always looking for an opportunity to maximize your dollar. And for those people who truly understood that and had the means to do it, it was a no-brainer of an investment. Like, correct me if I'm wrong, but when I spoke with people about it, once they got it, like they immediately wanted in once they understood. Is that what you saw too?
Yeah, I would say that that is 100% accurate. And I think there's one more thing that I'm going to add there, is that, look, with the market ceasing up, and in the last 18 months, there hasn't been anywhere as much purchasing going on because the deals is very difficult. We won't go there because I could just keep going with it. But what I'll tell you is people love to keep their money moving. They want to velocitize it. They want to be earning. And the smart, savvy people are not wanting to take their hard-earned money and just throw it at a property that somebody's taking down in hopes of a great outcome. And so where the fixed income fund really has been awesome is that we're able to also, in addition, keep their money earning and keeping it in flow and having it be in a guaranteed position. Because for some of you that are a little bit newer, look, you cannot offer and say it's a guaranteed return when people invest in multifamily properties. But the way we've positioned our fund, we're in that position to be able to share that it's more of a sure bet, right? So people are also loving the diversification of having their money in a guaranteed fixed income fund and have a return that is reliant on, and also being able to invest in multifamily. So I feel like it's just been really a win-win at the same time.
I'm going to stack on that and say we always celebrate when we have repeat investors in our properties, but I can tell you, because I'm the one monitoring it, we have several repeat investors in that fixed income fund as well. And I'll just straight up tell you, my mother-in-law 84 years old, jumped in and did half of hers compounding and half of hers simple, simply because she didn't know if she was going to be around long enough to see the benefits of the compound. She wanted to see some of that money. So I think Kim says she just smiles every time she sends that distribution to her. So, but I think it's awesome that we even have investors that love this product so much that they did go in and do it more than once because they knew what the benefit was. And you've got people in the property and taking benefits both sides of where the fund is. I think that's just incredible for us. Yeah.
Yeah, I love all of those pieces of this, right? The fact that it was well accepted, it was a way to preserve the original equity stack in the investment, and really, I mean, what we're trying to do here. Okay, yes, we had a great property, we had a lender problem that created a cash problem. We needed to solve the cash problem. We could either capital call it with a permanent solution, because capital calls are permanent. Once you make it, you can't undo it, and this fund it allowed us a way to solve a temporary problem with a temporary solution, because now that we created our own little debt fund, once we finish the work, the property revenues will now be such that it can support a better long-term low risk loan. And we simply unwind the whole debt fund like it never happened. And those people got to play, they got to save their project from fixing the cash problem, and they got to earn some interest along the way. So what a powerful thing. Now, as we bring it to a close, we took off from the real estate runway. We've been circling this notion of a capital call. I want to bring it up for, first off, any last minute comments. I, by definition, don't use that as a podcaster, but I know you guys can handle it as my team who have all the context here. So any last minute comments on it, but also I'd really love to talk through some of the best practices. And I'd love to start with Tammy on this one because she's been at the forefront of it. The best practices being, is it best to over communicate or not communicate at all when things are maybe not going according to plan, and maybe how we handled some of the, just making sure everyone understood what was going on. So if you wouldn't mind starting that. And then, as I mentioned, anyone who wants to put some finishing thoughts on this one of something we didn't cover, let's do that before we conclude.
I'm going to straight up say over communicate, because it's new to them when you're coming and saying, number one, hey, guess what? Our lender's not giving the CapEx funds anymore. It did somewhat put some of our investors in a bit of a panic because they didn't understand what was going on. But coming and having webinars and communications going out that is over explaining and sharing what our plan of action was to rectify the situation really gave a huge comfort level to our investors, that they knew that we were on the forefront. They knew that we were working hard to get it done. And I honestly don't remember what else you wanted me to say. What
I think you hit it. That was perfect. Just
okay.
Best practices around communication and like how we didn't just disappear and say, oh my gosh, we're so busy because things aren't going according to plan. We got to solve the problem. We don't have time to talk to you right now.
Right.
And then we show up with, hey, come invest in this new thing. Like, we were communicating the whole way through, identifying the problem, saying, hey, we're raising a flag here. We got a cash problem that's brewing because this hasn't happened. And they were walking with us as we discovered, oh, gee, after 6 months of fighting this, they're not going to give us any money. It doesn't matter how much we prove it to them, right? And so that's the best practice. Is you should be hearing from your operator, talking to you investors out there and you sponsors. You should be communicating more when things don't go well or according to plan. And investors, you should expect to hear more. You should expect of your sponsor over communication, help you understand the problem, because they're in the driver's seat. They are able to see the facts and understand it, and you don't have that benefit. So it's on, like, communication has got to be one of the biggest CTQs in who you choose to invest with. So again, last minute thoughts. I see a couple of you coming off mute. Please stack before we close the episode.
I wanted to stack on this
I want to
as well.
share.
That's okay. I wanted to stack on this as well and say a lot of times, operators don't welcome the questions. They don't welcome the phone calls. I will say this: through this entire process, all 5 of our phones have never been on mute. We've responded to every text message, every email, every phone call, you know, we've always, in the webinars, we constantly have someone operating the chat section, because we welcome the questions, because we may think we're answering everything and we're not. And the one thing I do stand behind and remain very proud of Quattro is that we have that open line of communication all the time, not just during a crisis. You know, we have been very over communicating and trying to answer every question. So
I love that you shared that. I think at the end of the day, I think it's super important for everyone listening to just make sure that you are linked up with the right operator. It's been absolutely incredible working with the Quattro Capital partners over the last 5 years, because we all are about impact and making sure that we're taking care of our investors the right way, right? And so I think I just have a couple examples that I want to share with you that in regards to our team and with this particular property. We did not end up taking a acquisition fee for this particular property. Some things changed at the end. And in addition to that, we also, when we created our fixed income fund, we are not, most managers of a fund are making between 2 and 5% managing a fund. We truly were about the property and how could we problem solve here? And we went into problem solve mode on behalf of our investors. And we did not even put a fee for us to earn on this fund. Why is it important for us to share, or for me to share that with you? Because think about it this way. We don't want to tax the property and burden it with us getting a fee. We want to still be able to execute on our business plan and be able to get those returns that we talked about from the get-go. And so if we pay ourselves, then we're burdening it a little bit, right? And so we're just doing what's best for the property, and we're making sure that we problem solve, come in with the fund how we have to be able to help with this particular property. And that truly is the Quattro way, about really being first for our investors and making sure that we can walk out, execute, and do a mighty fine job and get the great results that we've shared with our investors. So that's a differentiator.
Yeah, for sure. And you know, Erin, that's such an important part of being investor first mindset. And part of what goes along with an investor first mindset is a resident first mindset. And because we're taking care of people first, the number one pillar at Quattro Capital, take care of people. And that includes investors all the way down to the residents. That's what makes real estate successful. That is why a type of capital call that says, hey, if we keep improving the property, your investment is not only sound, but it is stellar. That type of capital call is not something anyone should be afraid of. In fact, embracing that and recognizing that there's ways to handle it so that everybody wins, that's what I hope folks take away. I also hope from the conversation that all of the listeners, whether they're operators, new or old, or investors, new or experienced, that all of that, everything that's happening in investment is a long-term play that will yield fantastic outcomes. You just have to have enough time for that slow cooker to make that fantastic meal that you're planning to enjoy in the end. It just takes, some things are crock pot, some things are microwave, and real estate is a crock pot or a slow smoker kind of cook. But when it happens, nothing beats it.
And folks, we're going to let that be the mic drop moment of the episode today. So team, thank you for coming on, sharing your individual insights as to, what's kind of evolved and doing some myth busting with us. Really appreciate your insight. I know the audience does too.
All right. Take care.
Bye.
All right, everyone. In summary, we have talked about now what is a capital call, what's common about it, what are the misconceptions, and we've kind of laid out an illustration for you of how our particular situation for the one capital call we've ever done actually played out and why we decided it was the right call. So in general, you've got some best practices now, whether you're a sponsor or an operator. The best practices being the sponsor should probably fund the shortfall first, which we did. We then got creative and created a way to solve a temporary problem with a temporary issue or temporary solution. And over communicate. I can't say that enough. That is the only reason any of this was successful and accepted the way that it was you have to take people on the walk with you. So thank you for joining the episode today. This has been a special edition. We're going to call this the Elephant in the Room podcast. And if you got any value out of today's show, like us, subscribe, pay it forward, share it with someone who needs to hear this, especially someone who may be experiencing a capital call right now or having to make one as an operator. Share this episode because there's some really good practices and some myth busters, quite frankly. So this has been another episode of the Real Estate Runway podcast, folks. Until next time, over and out.
We hope this episode was insightful and brought value to your day. If so, please be awesome and leave us a 5-star review. Find out how Team Quattro can help you at thequattroway.com and scroll down for more info. Until next time, this is the Real Estate Runway podcast.